Welcome back. In Chapter 23, we'll be examining exempt entities, entities that generally aren't required to pay taxes. We'll discuss what qualifies as a tax-exempt entity, which transactions and activities of those entities are taxable, which tax-exempt entities qualify as private foundations, and finally, how is non-entity business income taxed? We'll be illustrating these concepts using two not-for-profit entities that are close to me. Texas Tech University, Breckham, which is a state government entity, is not subject to income taxation, and Girls on the Run of Montgomery County, which is a STEAM building program for elementary students in grades 3 through 5. At the end of the program, the girls will run a 5K. I used to coach for this organization. Now, it's important to point out that tax-exempt entities are a big portion of our United States economy. Within the United States alone, there are 1.8 million entities registered with the IRS, and probably more than that when you include those who earn less than the $5,000 cutoff required to register. They employ 15 million people, which comprises 10% of the non-governmental workforce. They hold $3.7 trillion in assets. They comprise 5% of the gross domestic product. And in terms of size, they range from relatively small. About 60% of charitable organizations possess assets of less than $500,000 to relatively large. An organization like NPR or the Smithsonian, the largest 8% of charitable organizations account for 93% of assets held and 88% of revenue reported. Now, not-for-profit or exempt organizations typically use a dual budgeting and reporting system. And to illustrate this, let's look at some of the sources of revenue for my alma mater, Texas Tech University. The TTU operating fund is used to generate expenditures that support the entity's exempt purpose. So for Texas Tech University, it's an educational institution providing higher education. The revenue for Texas Tech includes, and these came from its 2018 financial statements, tuition and fees, sales and services of auxiliary enterprises, and federal grants and contracts. We'll talk about some of those subdivisions a little bit later. Another source of revenue for an exempt entity is the endowment. The endowment holds long-term funds contributed by donors or accumulating from the organization's operating surplus. Generally, the principal of the endowment is used to generate income, and the organization can only use the proceeds from that principal. To give you an idea, Texas Tech's endowment is around $1.1 billion. Each year, the endowment spins off around $300 million that the university can use for scholarships and other operating purposes. According to the IRS, there are 3 requirements to be granted tax exemption. The organization must serve the common good, must not seek to earn a profit, and its members must not derive benefit from the organization's net earnings. Let's take a closer look at what this means. First, serves the common good. Girls on the Run of Montgomery County is an educational organization providing esteem building activities to preteen and teenage women that has a local focus. Texas Tech University provides a public good, a state education, and has a focus for the whole state of Texas. Other organizations can have a more global focus, like the Red Cross, or a national focus, like the Smithsonian Institution or the National Public Radio. The organizations cannot go into business to earn a profit. they must provide a service and give it away. For example, Girls on the Run of Montgomery County does generate revenue from program registration fees, but these revenues are expended in the production of the service. Texas Tech University collects tuition and other grants and federal funds, and they expend these dollars in providing a service to its students. In fact, in 2018, Texas Tech University suffered an operating loss of $630 million. And that third requirement, members do not benefit from net earnings. What this means is that you can't tie the executives or the key personnel's salary to how well the not-for-profit operates, how effective it is at operating. While the executive in charge of Girls on the Run or the executives running Texas Tech University can receive bonuses for their performance can't be based simply on how well the organization did financially. Now, even though an organization is exempt from federal income taxes, it doesn't mean that the organization is free from paying all taxes. There are three primary exceptions. The first is an excise tax on lobbying. Lobbying is when an organization makes expenditures with the intent of influencing legislation by communicating with any legislator, government official, or staff person who develops legislation. Think of this in terms of the giant lobbying firms that line the streets of Georgetown in Washington, D.C. But not-for-profit organizations can lobby with the government also. Grassroots efforts intends to influence legislation by attempting to affect the opinions of the general public. For example, every other year, Texas Tech alumni, faculty, and staff head to Austin to go lobby for more educational dollars and more funding to Texas Tech. Lobbying activities are generally taken to either obtain a more favorable tax status, something that a tax-exempt organization already has, or to seek federal funding or other federal benefit. Lobbying expenditures can jeopardize the organization's exempt status. The federal government doesn't want to subsidize these exempt organizations, only to have the organizations turn around and demand things of the government. So, organizations that elect to participate in lobbying activities can be subject to a 25% tax on the excess of the lobbying or the grassroots expenditures, what they spent during the year, less the lobbying or grassroots non-taxable amount. We'll practice a few exercises on Wednesday that work through this taxation and these limitations. Now let's look at another type of tax that can be levied on exempt organizations, the excise tax on excess benefits. Remember, the not-for-profit or the exempt organization to provide a good or service to the general public. The general public wants to see these funds used equitably so that their benefit can be maximized. Accordingly, the IRS imposes a penalty on disqualified persons who engage in excess benefit transactions. A disqualified person is someone like Elizabeth McGlynn or President Lawrence Shuvnik, who have the potential to exercise substantial influence over the organization. And an excess benefit transaction is a transaction between the organization and the disqualified person that did not occur at fair market value. So rent between the organization and the disqualified person at less than market value would qualify, or unreasonable compensation paid to the disqualified person. So let's look at an example of that. This is Elizabeth McGlynn. She's the executive director of Girls on the Run of Montgomery County. Her 2018 salary was $138,000. Having served on this organization's board of directors, I know that the organization does market analysis every year to evaluate whether her salary is aligned with the salaries of comparably sized organizations in the same area. But let's assume that it's not. Let's assume that Elizabeth McGlynn is attempting to fleece the organization that only wants to build self-esteem in preteen girls. Sketchy stuff. Let's say that instead, the average executive salary for a similarly sized organization in Montgomery County, Maryland is $120,000. She's earning in excess of $18,000 above reasonable compensation. 25% of that excess can be taxed and must be repaid to the organization. If she has failed to repay the organization within a certain time period, she can be penalized with an additional tax of 200% of what the penalty was originally. Let's take a look at two other examples of federal taxes that may be applicable to tax-exempt organizations. First, universities may be subject to a 1.4% tax on their net investment income for the year. Think about the endowment earnings that grow based on how well the investments are doing, as well as the excess of profits from operating the university. This is similar to the retained earnings tax that corporations may be subjected to. Corporations pay this tax if the fair market value of the endowment divided by the number of full-time equivalent students is greater than $500,000. So Texas Tech had a pretty sizable endowment. Let's look at what that means. Assuming that Texas Tech had a full-time equivalent students of $35,000, this would equate to about $33,000 per student. Texas Tech is way off. In fact, only about 70 universities in the United States are subject to this tax. And second, just like a corporation that levies a tax on compensation paid to certain high-ranking officers, an exempt entity's top paid officers may also be subject to a tax on that compensation. Lawrence Shuvenick, the president of Texas Tech University, earns an annual salary of around $380,000. So he doesn't fall under this category. But Cliff Kingsbury, the former head football coach for Texas Tech University, did. In his terminal year of his contract, he was earning about $3.5 million, or an excess of $2.5 million above the $1 million ceiling. Texas Tech University would be subject to a tax equal to 21% of that excess. A certain subset of exempt organizations are considered private foundations. These organizations exist to hold investment assets and make annual grants to other organizations. The Pew Charitable Trust is an example. It's important to make this distinction between a private foundation and a public charity because private foundations are subject to additional taxes that a public charity is not. So let's look at what makes for a public charity versus a private foundation. First, there's an organizational requirement. An organization must fall into one of the three below categories to be considered a public charity. It has to be a favored activity, so a religious organization, an educational organization, a hospital or medical organization, or a governmental unit. Second, it could be an organization broadly supported by the general public, like a museum. And third, It could be an entity organized and operating exclusively for the benefit of an organization described above. For example, a public charity that exists to provide daycare services and administer those daycare services. So it's not enough for an organization to simply meet those three characteristics, one of those three characteristics. It must also meet certain funding requirements. More than 33% of its funding must come from external sources, and less than 33% of its funding can come from internal sources. By external sources, I mean gifts, grants, and contributions, as well as gross receipts from admissions, merchandising, and the performance of services. With regard to these gross receipts, it can only be applicable to related services. We'll get to unrelated business services in a little bit. Internal support includes those unrelated business income items, as well as gross investment income. This can include interest, dividends, rents, and royalties. Now let's evaluate whether Girls on the Run fits the bill as a public charity or a private foundation. This information came from the Girls on the Run Form 990, which is the informational form that each not-for-profit organization must file with the IRS each year. At the very bottom of this report section, you see the word summary. Whoever filled out this form on behalf of Girls on the Run described the organization's purpose as receiving, administering, and expending funds to athletically educate, there's that word there, and augment self-esteem in girls. Since Girls on the Run fits an educational purpose, the first requirement is met. Now let's take a look at the next requirement. This next section reports the revenue for Girls on the Run based on the type of revenue. Now remember, there are two requirements that must be met, inside funding and outside funding. So let's take a look at the inside revenue first. The only two items that could possibly be inside revenue on this form are the investment income and, conservatively, other revenue. This comprises about 1.5% of the organization's total income, which means that the first requirement for inside revenue being less than 33% has been met. Now let's look at outside revenue. This comprises contributions and grants, as well as program service revenue. Now, the IRS does put certain limitations on contributions and grants. It's limited to a certain amount per person and per source. Even if we estimate our outside revenue on the conservative side, that is, using only the program service revenue, this still gives us outside revenue of around 86%. If we estimate it less conservatively, by including all of the program service revenue, our outside revenue is 98.5%. So we can assume that Girls on the Run is a public charity. Now, charitable organizations sometimes engage in activities designed to earn a profit in order to supplement their programmatic revenue. This is called unrelated business income. Income derived from activities that are unrelated to the exempt purpose of the organization. For example, Texas Tech University receives significant revenue from Fox Sports Southwest, who airs its lesser football and basketball games, the ones that ESPN doesn't decide to pick up. For that matter, Texas Tech also earns revenue from ESPN. Girls on the Run of Montgomery County has a merchandise stand at both of its regularly scheduled events during the school year. This is a commercial enterprise unrelated to the purpose of the organization. The unrelated business income tax is equal to the corporate income tax rate on any unrelated business income earned by the exempt entity. The taxation, whether an item is taxable or is not taxable, is determined by the source of the income, not the use of the income. The exemption applies to all organizations, including state colleges and universities, and it has to be a material amount, greater than $1,000 for it to be relevant for tax reporting purposes. Let's talk about when unrelated business income is included. What makes unrelated business income unrelated? The IRS has 3 standards. The organization must conduct a trade or business. That trade or business must be substantially unrelated to the exempt purpose of the organization. And the activity must be conducted regularly. And to illustrate these 3 concepts, let's look at 2 organizations that provide funding to Texas Tech University. Fox Sports Southwest, which airs many of Texas Tech's baseball, basketball, and football games on television, and the Texas Tech Club. This is a facility located in the Texas Tech Stadium that serves a country club-like function to the Texas Tech community. They lease the space in the stadium and pay Texas Tech University for that space. So first, are both of those activities engaged to earn a profit? Yes. Second, is the trade or business related to the exempt purpose of the organization? Well, the purpose of Texas Tech University is educational. Education is a public good. One can argue that providing football and athletic services to the campus community helps engage students and keep them interested. So that's a related function. Having a football stadium where the football team can play, that's a related function related to the sports mission. But Texas Tech is not required to broadcast those games, and it's not required to host the Texas Tech Club. Those are ancillary to the main function of Texas Tech University. And finally, to be considered trade or business, it must be regularly conducted. This means the activity is conducted frequently and is conducted continuously. So the Girls on the Run example that I gave on the previous slide, it happens exactly twice a year, which is hardly frequently and definitely not continuously. The revenue earned from selling merchandise at their races is thereby related business income. The revenue earned from Fox Sports and the revenue earned from leasing the space to the Texas Tech Club is earned frequently and continuously. So those items constitute unrelated business income, and it would be taxed at a 21% rate. Now we'll practice more with the computation of unrelated business income tax on Wednesday when we practice some of the problems that appear at the end of this chapter. But for now, let's go over what goes into computing this amount. As with other income computations, we begin with revenue. We subtract from revenue the costs incurred to produce that revenue. So basically, in effect, the cost of goods sold. And that gives us net unrelated business income. From that, we subtract add the positive adjustments, subtract the negative adjustments, and subtract the $1,000 that are exempted from this amount. In the end, this gives us our unrelated business income, which is taxed at 21%. Finally, we'll close out our discussion by examining the reporting requirements for an exempt organization. An organization would apply for exemption status by completing Form 1023, Form 1023-EZ for smaller not-for-profit organizations, and Form 1024, which is the application for reorganization of exemption under Section 501A. This applies basically to the other exempt organizations. At the end of each operational year, the organization reports its results on Form 990, Form 990N, which is a postcard-sized form for the smallest not-for-profits, Form 990EZ, which applies to smaller nonprofits, and Form 990PF, which applies to public foundations. Any unrelated business income that needs to be reported is reported on Form 990T. These must be reported annually and must be made publicly available. This promotes the transparency dimension for the donors who support the organization.